What if the most popular investment strategy in Australia, the one that's built a two-ETF portfolio for countless investors, is no longer the undisputed king in 2026? The VAS and VGS combination has become legendary for its simplicity and diversification, but with new competitors, shifting market dynamics, and innovations in the ETF space, is the classic duo still the best option for your portfolio? Or have better alternatives quietly emerged? Let's find out. Before we dive in, a quick but important disclaimer. This video is for general informational purposes only and does not constitute financial advice. Investing involves risk, and you should consider your own personal circumstances, financial situation, and risk tolerance before making any investment decisions. When in doubt, always consult a licensed financial professional. Now, let's get into it. The Vanguard Australian Shares Index ETF, known by its ticker VAS, and the Vanguard MSCI International Shares ETF, or VGS, have become the cornerstone of Australian passive investing for a very good reason. Together, they offer a beautifully simple two-fund portfolio that provides broad exposure to both the domestic and global share markets. But why is this combination so powerful? First, let's break down the individual components. VAS is the undisputed heavyweight champion of Australian ETFs, with over $22 billion in assets under management. It's designed to track the performance of the S&P/ASX 300 index, which represents the 300 largest companies listed on the Australian Securities Exchange. This means when you buy VAS, you're buying a slice of Australia's largest and most well-known companies, from the big four banks and mining giants like BHP to healthcare leaders and major retailers. But there's a catch. The Australian market is famously concentrated. Financials and materials alone account for roughly 60% of the entire index. In fact, over 50% of any investment in VAS is tied up in bank and mining stocks. This lack of sector diversification is a significant risk that many investors overlook. You're making a big bet on the health of our banks and the ebbs and flows of global commodity prices. In 2026, with inflation re-accelerating and expectations for near-term interest rate cuts fading, these sectors are facing a challenging environment, making the portfolio highly sensitive to rate changes and economic surprises. To combat this domestic concentration, we bring in VGS. This ETF provides exposure to the MSCI World ex-Australia Index, which includes roughly 1,500 of the largest companies in developed markets across the globe, excluding Australia. This gives you instant diversification into the US, Europe, and other major economies. The top holdings in VGS read like a who's who of global innovation: Apple, Microsoft, Amazon, and NVIDIA. By pairing VAS with VGS, you're essentially building a portfolio that captures the growth of the Australian economy with its high dividends and franking credits, while also tapping into the power of global technology and other industries that are underrepresented on the ASX. It's a perfect marriage of domestic income and global growth. Now let's talk about the cost of this partnership. VAS charges a management fee of just 0.07% per annum, while VGS comes in at a still competitive 0.18%. On a $200,000 portfolio, a 60-40 split would cost you approximately $172 a year in management fees. That's an incredibly low price to pay for such comprehensive diversification and professional management. This is why the VAS and VGS combo has become the default recommendation for so many financial advisors. It's simple, effective, and dirt cheap. But is it the best? Let's explore three powerful alternatives that are challenging the VAS and VGS status quo in 2026. The first alternative is the all-in-one ETF. For investors who value simplicity above all else, funds like the Vanguard Diversified High Growth Index ETF, or VDHD, and the BetaShares Diversified All Growth ETF, known as DHHF, offer a one-stop shop. These funds hold a diversified mix of assets, including Australian and international shares, and for VDHG, a small allocation to bonds for a touch of security. DHHF, on the other hand, is 100% growth assets, meaning it's fully invested in shares with no defensive allocation. The appeal is incredible. You buy just one ETF and you're done. The fund manager handles all the rebalancing for you, ensuring your portfolio stays on track without you lifting a finger. It takes the emotion out of investing and prevents you from making costly behavioral mistakes. However, this convenience comes at a higher cost. VDHG charges 0.27% per annum, while DHHF is slightly cheaper at 0.19%. Moreover, with an all-in-one fund, you have less control over your asset allocation, and crucially, you lose the ability to sell specific assets for tax purposes. If you need to raise cash, you're forced to sell a proportionate amount of everything, which can trigger unwanted capital gains. The second alternative is the BetaShares low-cost duo, A200 and BGBL. This pair directly competes with VAS and VGS by offering a nearly identical exposure profile, but at a significantly lower cost. A200, as the name suggests, tracks the top 200 Australian companies, which are a large portion of the ASX 300 anyway. BGBL tracks over 1,200 global developed market companies, excluding Australia. Together, they achieve a similar diversification to VAS and VGS, but they do it cheaper. A200 charges a microscopic 0.04% per annum, while BGBL comes in at just 0.08%. On that same $200,000 portfolio, a 60-40 split of A200 and BGBL would cost you only around $104 per year. That's a saving of $68 annually, compared to the Vanguard combo. The question is, are the savings worth it? You're sacrificing a bit of liquidity and scale, as A200 and BGBL are newer and smaller than their Vanguard counterparts, but for the long-term investor, lower fees can make a real difference. The main drawback is that, like VAS and VGS, they lack exposure to emerging markets and small-cap companies. And now, for the third and most aggressive alternative, geared ETFs. This is where things get really interesting and, frankly, a lot more risky. BetaShares offers a range of geared funds, including GHFF, G200, and GGBL. These are complex ETFs that use internal gearing to amplify returns. They borrow money to invest, maintaining a leverage ratio of roughly 30 to 40%. This means if the underlying index goes up by 10%, your geared ETF might go up by 13 or 14%. Sounds fantastic, right? Who wouldn't want magnified returns? But here's the catch. Losses are also magnified. If the market drops by 10%, your investment could drop by 13% or more. This makes geared ETFs extremely volatile and not suitable for the faint-hearted or those who panic sell during market downturns. The cost of this leverage is also higher than traditional ETFs, with management fees often exceeding 0.50% per annum. It's essentially a bet that the market will go up, and while it can turbocharge returns in a bull market, it can be devastating in a bear market. So, where does that leave us? We've explored the legendary VAS and VGS combo, the simplicity of all-in-one ETFs, the cost-effectiveness of A200 and BGBL, and the high-risk, high-reward world of geared funds. The truth is, there is no single best portfolio for everyone. The right choice depends entirely on your individual circumstances, your risk tolerance, your investment time horizon, and how hands-on you want to be. If you're a beginner who wants to invest and forget about it, the simplicity of an all-in-one ETF like DHHF or VDHG is incredibly compelling. It takes the guesswork out and builds a globally diversified portfolio for you in a single trade. If you're a cost-conscious investor who wants to maximize long-term returns by minimizing fees, the BetaShares A200 and BGBL duo offers unbeatable value. But if you're a more experienced investor who values the unmatched scale, liquidity, and track record of the Vanguard funds, and you want the control of managing your own Australian and global allocation, then the classic VAS and VGS portfolio remains a fantastic choice. And if you have a high risk tolerance, a long time horizon, and the stomach for extreme volatility, geared funds could potentially supercharge your returns, but only if you have the discipline to hold on through the inevitable downturns. In summary, the VAS and VGS portfolio is a brilliant, time-tested foundation. But in 2026, you have more power and more choice than ever before. The best portfolio is the one you can stick with through thick and thin. It's the one that aligns with your goals and lets you sleep soundly at night regardless of what the market throws at you. Thanks for watching. If you found this breakdown helpful, please hit that like button and subscribe to the channel for more deep dives into the world of Australian investing. And let us know in the comments below, which portfolio strategy are you leaning towards? The classic VAS/VGS, the all-in-one simplicity of DHHF, the low-cost A200/BGBL, or are you brave enough to consider a geared approach? We'd love to hear your thoughts. See you in the next one.